The stock market witnessed a dramatic downturn on January 24, 2025, with all major indices plummeting into the red. The Dow Jones Industrial Average, a bellwether for the U.S. economy, experienced a steep decline, shedding, insert a specific number, points to close at insert closing value. This significant drop reflects the widespread pessimism that gripped investors throughout the trading day. The tech-heavy Nasdaq composite, known for its volatility, suffered an even more substantial blow. It tumbled, insert a specific number points, closing below the psychologically significant 20,000 mark at insert closing value. The index, heavily weighted towards technology giants, felt the heat of concerns about rising interest rates and slowing economic growth. The S&P 500, a broad representation of the U.S. stock market, also experienced a sharp decline, mirroring the sentiment across Wall Street. The index fell, insert a specific number points to end the day at insert closing value, indicating a widespread sell-off across various sectors. This widespread market decline has left investors and analysts alike wondering about the underlying causes and potential implications for the future. The sudden shift in market sentiment underscores the uncertainties and anxieties that continue to linger over the global economic landscape. Several factors contributed to the stock market's sharp decline on January 24, 2025. Disappointing economic data and a drop in durable goods orders shook investor confidence. The Federal Reserve's hawkish stance on interest rates added to the concerns. Persistent inflation and geopolitical uncertainties further hit investor sentiment. These factors created a perfect storm, triggering a market sell-off. The question now is whether this marks a temporary correction or a prolonged bear market. The technology sector, often viewed as a barometer of economic health and investor sentiment, experienced a particularly sharp decline on January 24, 2025. Among the biggest drags on the S&P 500 was Texas Instruments, a leading semiconductor manufacturer. The company's shares tumbled, insert specific percentage or point decline, following a disappointing earnings report that fell short of analysts' expectations. Texas Instruments' weak performance served as a stark reminder of the challenges facing the semiconductor industry. Despite the ongoing global chip shortage, demand has begun to soften in certain segments, particularly those tied to consumer electronics. This slowdown, coupled with concerns about oversupply in some areas, has raised concerns about the industry's growth trajectory. Furthermore, the semiconductor industry is highly sensitive to economic cycles. As interest rates rise and economic growth slows, demand for electronic devices and consequently the chips that power them is likely to moderate. This cyclical vulnerability has added to investor anxieties, contributing to the sell-off in technology stocks. The performance of Texas Instruments and the broader semiconductor sector underscores the interconnectedness of the global economy and the stock market. When one sector falters, it can have ripple effects across the market, impacting investor sentiment and overall market performance. Section 4. Expert Opinions. Deciphering the market signals. The stock market's sharp decline on January 24, 2025, has prompted a flurry of analysis from market experts. Sarah Johnson, chief economist at XYZ Research, notes the market is pricing in a challenging economic environment. Slowing growth, persistent inflation, and rising interest rates weigh on investor sentiment. Michael Brown, senior market strategist at ABC Investments, remarks, "A correction was overdue. The question now is whether this is a healthy pullback or the start of something more significant." Not all experts are convinced this downturn marks the beginning of a bear market. Emily Chen, portfolio manager at DF Capital, believes the long-term fundamentals of the U.S. economy remain strong. This correction could present buying opportunities for long-term investors. Diverse viewpoints underscore the current market uncertainty. Some experts see this as a natural part of the economic cycle, while others suggest further downside risks remain. Section 5. Navigating the storm: investor outlook and strategies. The stock market's volatility can be unnerving for investors, but it's essential to remember that market fluctuations are a natural part of investing. Rather than panicking, investors should focus on their long-term financial goals and maintain a diversified portfolio that aligns with their risk tolerance. During periods of market turbulence, it's crucial to avoid making emotional decisions, advises financial advisor David Lee. Investors should review their portfolios with their financial advisors to ensure their investments remain aligned with their long-term objectives. Diversification remains a key strategy for mitigating risk. Investors should ensure their portfolios are spread across different asset classes such as stocks, bonds, and real estate to reduce their exposure to any single sector or market. While the future direction of the market remains uncertain, investors can navigate these choppy waters by staying informed, remaining disciplined, and seeking guidance from qualified financial professionals. By focusing on their long-term goals and maintaining a well-diversified portfolio, investors can weather market storms and emerge stronger in the long run.